Hello everyone and welcome to edupediaworld.com. Today we are going to discuss the two remaining topics of this unit, accounting principles and concepts. These two topics are number 1, the fundamental accounting assumptions, and number 2, the characteristics of the financial statements. So in today's class we are going to discuss these two topics. That is, number 1 is the fundamental accounting assumptions. What are the fundamental accounting assumptions which we have to follow while preparing any financial statements? And number 2 is the characteristics of financial statements. What are the basic characteristics and attributes of a standard financial statement that we prepare? So let us start today's class. So these are the three fundamental accounting assumptions which every accountant has to follow while preparing the financial statements. These are the basic accounting principles which we have to follow irrespective of anything. Whatever may be the case, whatever may be the size of the organization, whatever business the organization is doing, these three accounting principles has to be followed. It is assumed that while preparing the financial statement, the accountant has followed these three accounting principles. We have already discussed them in detail, but now let us just discuss them in brief in this class. Going concern. Going concern is an accounting assumption in which it is assumed that the enterprise for which we are preparing the financial statements is a going concern and will continue in operation for the foreseeable future. So we assume that for the entity for which we are preparing the financial statement, that entity is going to last for a foreseeable future. Hence, it is assumed in this principle that the enterprise has neither the intention nor the need to liquidate or curtail materially the scale of its operation. So this is the going concern concept, in which it is assumed that the enterprise for which we are preparing the financial statement is going to last for a foreseeable future, and the enterprise has no intention to liquidate its operations in the near future. Second is consistency, principle of consistency. This principle says that the accounting policies should be followed consistently from one period to another. So whatever accounting policies, for example, the depreciation policy of the enterprise, the valuation of asset policy of the enterprise, whatever may be the case, whatever policy the company or the enterprise is following, that should be consistently applied from one period to another. A change in the accounting policy should be made only in exceptional circumstances. For example, if the company is following the straight line method of depreciation, then it should follow that method consistently from one period to another, and it should not deviate from SLM to WDV from one period to another. For example, in one accounting year, it is following the SLM method, and in the next accounting year, it switched to the WDV method. So this is not proper. It can change its accounting policy only in certain exceptional circumstances, which we have already studied. This is important because it helps us in comparing the financial statements of the enterprise through time. If we'll keep changing the policies, then it becomes really difficult for us to compare the financial statements of two financial years. So in order to achieve the comparability, the consistency principle has to be followed. This is the second fundamental accounting assumption while preparing the financial statement. Now comes the third accounting principle, that is the fundamental accounting assumption, and that is accrual, the concept of accrual. This concept says that the revenues are recognized as and when they are earned and not when cash is received, and simultaneously The expenses are also recognized as and when they are incurred and not when cash is paid. So this is the concept of accrual. We recognize the revenues and expenses as soon as we earn them or incur them, and we do not wait till the cash is received or paid. It may happen that we make sales of some items on credit and the cash is received at some later date. So we have to recognize the sale as and when it takes place, and we should not wait for the time when the cash is received for that sale, because this is the basic foundation on which the whole accounting is based. Accrual. We should recognize the revenues and expenses as soon as they are earned or incurred, and the cash part should not be involved in it. The cash may be received or paid at a later date, but what we have to keep in mind, or what is important, is the time when we earn the revenue or the time when we incur the expense. That time we should record the revenues and the expenses. And when the cash is received or paid, that is not taken into account, the date on which the cash is received or paid. We should just concentrate on the dates when the revenues are earned and when the expenses are incurred. So this is the accrual concept. So these are the three fundamental accounting concepts which we have to follow while preparing any financial statement of any enterprise: going concern, consistency, and accrual. If nothing has been written about the fundamental accounting assumptions in the financial statements, then it is assumed that they have already been followed in the preparation of financial statement. So as I have told in the starting of the slide, that these are the fundamental accounting assumptions. It is assumed that these are followed while preparing the financial statement. We do not have to mention this fact that we have followed these three accounting concepts while preparing the financial statement. It is assumed beforehand only. However, if any of the above mentioned fundamental accounting assumption is not followed, then this fact should be specifically disclosed. So if we are not following any of these accounting assumptions, then we need to mention it in the financial statement that we have not followed this concept or this concept. That is required to be disclosed. But if these three have been followed, then there is no need to specifically mention, because it is already assumed that these three accounting principles have been followed while preparing the financial statements. Now, let us come to the second topic of today's class, that is the qualitative characteristics of financial statements. What characteristics any financial statement should possess, so that it can be easily interpreted by the users, the end users. What should it possess? What are the various characteristics it should possess? Number one is understandability. So, any financial statement that's prepared should be prepared with the purpose and with the aim that it can be easily understood by the users, the end users, whoever are the users of those financial statements. It should be easily understandable by those end users. So this is the first and foremost characteristic of any financial statement. It shouldn't be like the accountant has prepared the financial statement as per his convenience, and when it comes to the end user, he is not able to understand that financial statement, and the financial statements are very vague. So the first and foremost thing which the accountant should keep in the mind is it can be easily understood by the end users. Second is relevance. So while preparing the financial statement, the accountant should be very careful that whatever he is presenting in the financial statement, he is presenting in a relevant manner, because if he will present information that is irrelevant to the end users, then it is of no use to them. So it is very important that the whatever information he is presenting in the financial statement, it is relevant to the decision making needs of the users, so that when the end users are going through the financial statement, they find the statements relevant to their decision making needs. Whatever decision, whatever thing they are finding and trying to find in the financial statement, they can find it very easily, and they can relate it with their needs, whatever they want to know from that financial statement. It depends on user to user, what is relevant to them in their personal capacity. For example, the internal users has something else for their needs. The external users are looking for something different in their financial statement, which is important to their need. So it depends. But the accountant has to keep everyone in the mind, all the end users in the mind, and should prepare the financial statement in such a way that it is relevant to the end users, and the end users can use it very easily and make various decisions by going through the financial statement, by studying the financial statement. So the financial statement should be relevant in this respect. The information provided should be relevant and not irrelevant, so that it may happen that the end users find the financial statement irrelevant because they could not find any information which they are trying to find for their decision making needs. So it is very important that the information is presented in a relevant manner. Next comes reliability. So the information presented in the financial statement should also be reliable other than relevant and understandable. It may happen that it is understandable and relevant, but it is not reliable. That is, the facts and figures presented in the financial statement are not free from material error and bias. It has happened that the accountant has committed some errors while preparing the statements, or he has biasly done something in the financial statement, so the statement look according to the way he wants. So this should not be the case. The financial statements should be reliable so that the end users can easily rely on the facts and figures presented in them and then act accordingly. If the financial statements are not reliable and are not free from error and bias, then it is of no use, and the end users will not rely upon the facts and figures presented in them. And if the financial statements are of no use to the end users, it does not hold any importance. So it is very important that apart from being understandable and relevant, it should also be reliable, that is free from errors and bias. The next characteristic is comparability. The financial statements should be prepared in such a way that the users are easily able to compare the results of the previous year with this year. That is why one of the fundamental accounting assumption is consistency. This is for this reason. The financial statement should not be prepared by changing the accounting policies every year. The accounting policies should be kept consistent over a period of time. Why? Because of this characteristic. It should become comparable. This consistency concept is followed by the accountant to make the financial statement comparable over the period of time. So, this is one of the important characteristics of the financial statement, that is comparability. It should be prepared in such a way that it is easily comparable over a period of time, and the end users can easily compare the results of the previous year with this year and can compare the incomes, expenses, assets, liabilities, the change in them, what change has come over 1 year in them. So this should be there. It can be easily comparable, and for that We need to follow the concept of consistency, and we need to follow the accounting policies consistently over a period of time. And if there is any change in the accounting policy due to extraordinary circumstances, then the accountant is required to disclose it specifically in the financial statements so that the end users have them in their mind that the accounting policies have changed. So this is the characteristic of comparability. Now, these four characteristics, that is understandability, relevance, reliability, and comparability. These are the four principal qualitative characteristics. Principal means these characteristics has to be there in any financial statement. These are very important, and without these characteristics, the financial statement are of no use to the end users. So these are the four principal characteristics. Just remember the four principal characteristics. What are they? Understandability, relevance, reliability, and comparability. Now, fifth in the line is materiality. While preparing the financial statements, the accountant should keep in mind that he has not left behind or he has not committed any error in representing the material item in the financial statements. The immaterial items, for example, the items of a smaller amount, if they are misstated or if any error is committed in representing them, then it does not affect the financial statement in a much way, like it is okay. It does not affect the understandability, reliability, and relevance of the financial statement in a very big way. But if any information of material item, the materiality depends on the size of the item. If any item which is in bigger size and which is of bigger amount and which can affect the decision of the end users, if it is misstated or if it is containing any error, then that affects the financial statement in a more severe way. So it should be kept in mind by the accountant, and it should be very specific for the accountant that he do not commit any error or he do not omit or he is not committing the error of representing the item of material importance in the financial statement. He has to keep special precaution that all items of material thing are properly presented and are error free in the financial statement, and they are not omitted from the financial statement. So this has to be kept in mind by the accountant while preparing the financial statement, that all material items are properly displayed and depicted in the financial statement so that economic decisions of the end users are not affected by any error in the material items. The next characteristic is true and fair representation. In this characteristic, it is given that the accountant should not manipulate the data given in the financial statement for the sake of good, you can say that the financial statements look good in front of the end users. For that purpose, he should not manipulate the data. He should be very faithful in representing all the facts and figures in the financial statement, whether they are in favor of the organization or they are against the organization, whatever the case may be. He should be very faithful in representing those facts and figures. It shouldn't be the case that if any data is against the goodwill of the enterprise or it is not in favor of the organization and it can affect the goodwill of the organization in the eyes of the end users. So he should not manipulate the data into something good. He should very faithfully represent that data in the financial statement. So he is liable to present the financial statement in a true and fair way. You should be very faithful in representing the facts and figures in the financial statement. Facts and figures should be true and fair and should not be manipulated at all to lure the end users. Next comes the characteristic of substance over form. If any information is to represent faithfully the transactions and other events that it purports to represent, it is necessary that they are accounted for and presented in accordance with their substance and economic reality and not merely their legal form. So any information presented in the financial statement, it should be presented if it is a economic reality and not merely if it is a legal reality. It should be concrete. For example, I'll give you that if we have engaged in the selling of an immovable property and we have sold the property to an outside party, but the legal documentation has not been done yet. So it is our responsibility to record the sale in the financial statement, though the legal formalities and documentations have not been done by us, because it is the economic reality that matters and not the legal form. Economically and in substance, we have transferred the immovable property and now we are not the owner of that property. So we cannot show that as an asset in our financial statement. We have to show it as a sale in our financial statement, though the documentations and legal formalities are pending. So this is what substance over form characteristic is there. All information having economic reality should be presented in the financial statement, whether or not the legal documentation and legal formalities have been done or not. Next characteristic is neutrality. We have already discussed in the characteristic of reliability that the financial statement should be free from error and bias. So this is the same thing. Neutrality means free from bias. So the information presented in the financial statement must be neutral, that is free from bias. That is, the accountant has not been bias in presenting any information. Bias means if he thinks, okay, this information will make the financial statement look better, so he will manipulate that statement, that information and present it. And if some information will not make the financial statement look good, he will manipulate it in such a way that it makes the financial statement look better. So this should not be the case. The financial statement must be neutral and free from bias. Whatever is reality should be presented in the financial statement so that it does not influence the decision and judgment of the end users. The next is prudence. The preparers of the financial statement have to assess the uncertainties that inevitably surround many events and circumstances. For example, the collectibility of receivables, that is the collection of money from debtors, the probable useful life of plant and machinery, and the warranty claims that may occur. So these are some uncertainties that surround the business at every point of time. So such uncertainties are recognized by the disclosure of their nature and extent and by the exercise of prudence in the preparation of financial statements. The accountant, that is the preparer of financial statements, should be prudent enough to recognize the degree of uncertainty connected with all such events and circumstances. He should disclose it in the financial statement that okay, such debtors have become insolvent and it is very less likely that they will pay us, or the useful life of plant and machinery has deteriorated. Whatever the case may be, he should be prudent enough and he should assess all these uncertainties and should report it in the financial statement so that the end users can make their decisions and judgments accordingly. So this is the characteristic of prudence. He should very smartly assess the uncertainties, the degree of their happening or not happening. He should assess them properly and then disclose it in the financial statement. The next in line is full, fair, and adequate disclosure. So the accountant should make sure that he has disclosed all the reliable and relevant information about the business enterprise in the financial statement, which will help in the decision making process of the end users, whether it is the internal users or the external users. So he should make sure that he has disclosed all the information required in making any decision by the end users, so that the decision is not affected. The end users are able to make the reasonable and rational decision based on the disclosures made in the financial statement. If the accountant manipulates and he do not disclose all the information, or he do not disclose the fair information in the financial statement, then it will directly affect the decision making process of the end users, and if the decisions made by the end users are not correct or not rational, then their financial statements are of no use, because ultimately the financial statements are prepared for the decision making process of the end users. So it is very important that all the information is fully and fairly disclosed in the financial statements. And lastly, completeness. The financial statements should be complete in all respect. It shouldn't be the case that it is incomplete, or some information is left, or some items are not included. This should not be the case. To be reliable and relevant and also understandable and comparable, the financial statement is required to be complete in all respect. If it is incomplete, then the end users are not able to make the proper decisions. So it is very important for any financial statement to be complete in all respect, so that it is of importance to the end users. So these are the 11 qualitative characteristics of any financial statement. These characteristics should be present in all the financial statements, so that the financial statements are of use to the end users, and the end users can make rational and reasonable decisions and judgments based on the financial statement. If any of these characteristics is not present in the financial statement, then that financial statement cannot be said to be a perfect one, and it will affect the decision making process in some way of the end users. So the financial statements should be complete in all respects and should have all these qualitative characteristics. And what are they? They are understandability, relevance, reliability, comparability, materiality, true and fair representation, substance over form, neutrality, prudence, full, fair, and adequate disclosures, and completeness. These are the 11 qualitative characteristics of any financial statements. Thank you, students. Hope you have understood today's class. The two topics discussed, that is the fundamental accounting assumptions and the qualitative characteristics of any financial statements. Thank you.